Hello, everyone. Welcome to the Final Bar. It's Monday, December 12th. We're going to talk about seasonality today. We are in the seasonally strongest part of the year in December. What does that mean for November, December, and then into the beginning of next year? Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. StockCharts is designed to help you do three things: bring exceptional tools to bear to understand these markets, give you the education and educational resources you need to make better decisions, and provide expert commentary from some fairly knowledgeable experts like John Murphy, Martin Pring, Larry Williams, Tom Bowley, Greg Schnell, many, many more in our group of fantastic contributors, all trying to make sense of these markets along with you. And on Friday's show, we talked about the distribution phase going into the close, right? The last hour of trading on Friday, serious distribution, sort of a flat day that went into a negative day very, very quickly. Today's sort of the opposite, right? We picked up where we left off right around 39.35 and then essentially just dribbled on to the upside with an acceleration to the upside going into the close today. So while Friday finished in a position of weakness, Monday finishes with a position of strength, not quite getting to that 4,000 level, which could be an important level to watch going through the course of this week. But getting really, really close with the S&P getting up to 3,900. That's up almost a 1.5 or 1.5% from Friday's close. We have a lot of really good charts to go through with you and try to review with you. Coming up on the show here through the remainder of this week, I'm super bummed because we had Jeff Hirsch of the Stock Traders Almanac all lined up to be on the show today. He is down with the flu, and we wish Jeff a quick and speedy recovery. It seems to be going around everywhere right now, so unfortunately, it impacted the Final Bar today, but we will get him back as soon as we can. He's very excited about coming back on and sharing some great expertise and charts with you. So the remainder of this week, here's our plan. On Tuesday, the 13th, we have Sean McLaughlin, the options strategist at All Star Charts. Sam Burns is going to be with us on Fed Day, Wednesday, the 14th. He's the chief strategist at Mill Street Research in Boston. Then on Thursday, the 15th, we have Hema Reddy. Hema was on the show not too long ago. Had a really good response to her visit. She is an expert in Gann, Fibonacci, cycle analysis. And I'm always really fascinated with someone like Hema is seeing in the markets because her toolkit differs so much from mine. I found a lot of value in my career of opening up to perspectives and approaches that differ from my own. Also wanted to let you know about our next upcoming free webcast from Market Misbehavior. It's actually tomorrow on Tuesday, December 13th at 1 p.m. Eastern, called 5 Best Practices for Stops. I learned technical analysis in 2000, 2001. I'm arguably still learning it, but that's when I was first introduced to the topic. And for me, it was all about risk management and navigating the tech bubble bursting using a good technical toolkit to manage risk. I'm going to share with you some of the expertise that I've picked up over my career in the time after that point, particularly in risk management and how to use stops. I'll share with you some of the ideas that I've applied in my own investing, some of the expertise I've picked up from others in the industry. You can sign up for that free event at Market Misbehavior/stops. And again, that's tomorrow, the 13th at 1 p.m. Eastern. Let's continue on our show today with our market recap. As I mentioned, nice move to the upside today. Yesterday, or a Friday show, that is, finishing in a position of weakness. Last hour on Friday, really changing the character of the market. Today, almost the opposite, although to be honest, the whole day was fairly accumulative, right? The momentum sort of built from the open and continuing on. And by the end of the day, energy up over 2.5%, utilities and technology both up over 2%. The major averages up as well. Let's look at the charts and see what actually happened today. The S&P 500 finishing up 1.4% to 39.90. That's a nice response to Friday's show, or Friday's session. I remember on Friday and over the weekend, as I'm going through the charts, I'm thinking, this actually could be setting up for a really painful beginning to next week. you're getting the opposite. You're getting a nice bounce here, a little bit of optimism. Now, of course, there are a lot of things to think about, particularly the Fed meeting coming up on Wednesday. So generally speaking, usually expect a bit of a quiet sort of week until the Fed, and then expect quite a bit of movement afterwards. Now, we have some inflation data randomly today. Tomorrow's CPI number at 8:30 is another one to pay attention to, of course, as well. The Nasdaq up 1.25%, and mid caps and small caps both up about 1%. So sort of a large mega trade leading things higher, and the VIX moving higher as well. Talk about an interesting chart. Look at the chart of the VIX. Look at how it's bounced off of just below 20, now up to 25, sort of essentially in the middle of the range for 2022. Really interesting bounce, and volatility increasing on today, which was an update for stocks. So again, a lot of times we sort of get into a habit of thinking S&P goes up, VIX goes down, and the opposite, S&P down day, VIX up day, but it's not always the case, right? It's looking at different data sets. And today we had an increase in volatility as the market accelerated to the upside, potentially renewed optimism for a soft landing that we might hear about in the next couple of days here. Interest rates overall moving higher through the course of the day. Bonds actually opened the day a little stronger, but came off, and that pushes interest rates higher. The 10-year yield finishing the day above 360. 5-year yields above 380. The dollar index essentially flat from Friday's session. Gold pushing down along with silver and copper. So the metals, precious metals, industrial metals, for the most part, are all moving to the downside. But commodities as a whole were higher. That's because of the strength in energy and other things like soft commodities. So oil prices moving higher along with natural gas. The energy sector, as I mentioned, the top performing sector today. Let's look briefly at a chart of the S&P 500, then we'll continue on looking at some other items here. This is the daily chart of the S&P 500. So on Friday, we're below 3950. We're bouncing higher and then rotating lower by Friday's close. Today, bouncing to the upside. It's not really a candle pattern that comes to mind looking at that 2-bar pattern, but certainly showing some renewed strength, opening at the low, closing at the high. So just a nice accumulation phase through the course of the day. Again, the benefit of charts is if you're just looking at what happened today, pretty optimistic, right? Pretty bullish feel. Just the day's trading was higher. Major averages are higher. A lot of individual names, particularly the FANG names, most of them having a pretty decent day. And don't get me wrong, short term, that is certainly encouraging. But the benefit of charting is that you can take a step back and look at what has really changed in the overall structure of the market. And I would argue, well, today was a nice bounce. Does it really change the overall trend that we've been in? Not yet, right? And it could, right? It could, if it continues higher. And that's why I think charts can be very, very valuable, particularly if you think about long-term support and resistance, long-term trends, long-term moving averages, and either visually look for triggers or set alerts on a platform like StockCharts to have the system tell you when a key level or a key signal has actually played out. So with today's rally, we're still below 4,000. So we get above 4,000. That's still below this key Fibonacci level that we've talked about for quite some time, right? That's based on a number of different frameworks, sort of the August to October sell-off, the January to October sell-off. 4,000 ends up being an important level for a number of different timeframes, which is why we've paid attention to that, and certainly getting above there would be encouraging. Even more encouraging would be getting back above the 200-day moving average. If you remember, a couple of weeks ago, we closed above there one day. Every day after that, for about a week, lower closes. Took a couple of days to get back below the 200-day, but that was the high bar for this sort of rally phase off the October low. And we never got above this trend line, which I think is a key one. Now, why do I keep bringing up this trend line and thinking about the long-term trends? It's for this reason. It's so clear on the charts. And what I've found in this industry is when something is really clear and there's a clear connection of the 2022 highs, I know I'm not the only one that has mentioned this, and I talked to a lot of my peers in the industry, a lot of them obviously keying in on this as well, which means a lot of people are getting this message, particularly institutional investors. As long as we stay below this line, things are actually still sort of in a waiting mode. We get above that line, I would expect you see a lot of demand. You see an influx of optimism because that's sort of that last line of resistance. There, I would look up to 4,300, 4,325, which would be a return up to the August highs. In a few minutes here, we're going to talk about seasonality, and we'll talk about why that could be an interesting play into the seasonal trends that often take place at the end of the year. Just to finish off here briefly on our market recap, just to point out the sector movements. Energy, number one, up over 2.5%. Utilities number 2, which is an interesting data point we'll come back to a little later in the show today. Technology and industrials rounding out the top 4. On the downside, consumer discretionary. So while this market is moving higher, you have stocks like Amazon kind of struggling up today, which is good. But overall, not too far off of 52-week lows. Tesla right at a new 52-week low today, selling off through the course of the day today. So while there is some sign of encouragement, it's not everything, right? You're seeing some signs of weakness in some areas of the market that you would expect to be stronger if the market is in an encouraging phase here. Next up, we wanted to do a segment called Making Sense of Seasonality. And again, we had Jeff Hirsch lined up, and he sends his apologies. He was really excited to come on with some really cool charts to look at together. We will get him back on here, and I think it may be at the beginning of the year because he can share with us his outlook for 2023, and we'll be able to ask him some questions about the seasonal trends. We had Jeff on, not on this show, but elsewhere on StockCharts TV earlier this year, actually at the beginning of the year. We had a special event on presidential cycles, and we talked with him, Sam Stovall. I think Tom McClellan might have been on that special, and I forget when exactly that was, but I remember having a good conversation with him. I wanted to go to one of the charts that Jeff shared on that show because I think it's been an interesting way of thinking about 2022. If you look at what Jeff was saying back in January of this year, almost 12 months ago, this was a chart that we looked at together, and it's basically the midterm election year, right? We've talked a lot randomly about seasonal tendencies, and particularly in a midterm election year. So seasonality is all about what tends to happen during the calendar. So on Jeff's chart here, we have the 12 months of the year, and then this is showing you the average returns in different time frames. So in black, we have sort of the average tendency for the S&P 500 during midterm election years, right? So that's sort of the middle of the election cycle after the presidential election, 2 years, and then we've got 2 years to the next presidential election, so right in the middle. So as you can see in the black line, overall tends to be pretty positive, right? Tends to be encouraging, but there are some seasonal trends, right? Tends to be pretty strong in the first quarter, actually tends to taper off in the third quarter and really accelerate to the upside in the fourth quarter, which is why a lot of people, myself included, have made the point that November and December actually tend to be pretty strong in any year, but especially in a midterm election year. And November very much played out the seasonal tendencies, beautifully, right? Strong November after a weak September and October. So this 3-month period, thumbs up so far. And then a nice move to the upside is projected for December. I don't know if we've necessarily seen that so far. We've seen the market sputter out, trying to get above the 200-day moving average. So the seasonal tendencies would suggest some strength going through year end. But this was the point that Jeff made that I thought was really, really interesting. If you look at midterm years, if you look at first-term midterm years, second year with a new Democratic president midterm. So this is basically all the different ways you could categorize this particular situation that we're in. Now, the challenge with making it more specific, right? Not just a midterm election year, but a midterm election year with a new Democratic president, and that sort of thing, right? So much fewer observations since 1946. But if you look at it, the picture becomes less and less rosy. So the reality was, second year of Biden's term, his particular midterm election year, when you look at the history, it's actually been pretty painful. And if you look at all of these different seasonal patterns, from black, which is actually all years, not just midterm years. Blue is just midterm election years, and then these other ones are color coded in the legend here. You can see that the most specific, the most closely related to what we're experiencing in 2022 is this red line. You can see it's actually the least encouraging of them all. So I remember Jeff having sort of a negative feel for 2022, given the particular configuration we had, and to his credit, it's been pretty close in a lot of ways to what we've actually experienced in 2022. Having said that, November and December actually tend to be pretty good. And in general, these midterm election years have bottomed out in September, October, along with the overall market, the average seasonality. But November, December, and all of these different scenarios tend to be pretty strong. Now, let's look at the actual market and see what's actually played out. How closely did we stay to these seasonal tendencies? So here's essentially your year-to-date chart. If you looked on that red line on the previous one, which was the second-year Democratic president, had a bottom in June and a bottom in October, overall negative trend. November, December, pretty strong. Not bad in terms of the overall trajectory of the market in 2022. The cause for caution, given this particular setup, but also the cause for optimism going into year end. So what I've mentioned a number of times, which I think is still the case here, While I see a lot of signs for caution in terms of the overall structure of this market, I can't help but recognize the fact that seasonal tendencies tend to be very strong going into the new year, November and December. Now, we also have a seasonality tool on StockCharts.com. And the way you get to it, by the way, is at the top instead of Sharp Charts, which is what you're usually used to bringing up, go down to where it says seasonality, and then you can put in a ticker. When you do that, I've just put in the SPY, and it's showing me basically a histogram. Same thing, the 12 months at the bottom of the chart. And then these numbers, you have two sets of numbers here. The numbers above the bars and the bars themselves are giving you essentially the batting average. What percent of the time for this month, going back X number of years, which you can change at the bottom, what percent of the time do we close higher than we open? And you can see essentially the batting average. So November tends to be 80% of the time tends to be a positive month. December, 70%, two of the strongest months if you go back through the 12. These lines or these numbers at the bottom of each histogram tell you the average returns. Again, it's taking all of the observations over the last 20 years, those particular months. What was the monthly return, average monthly return during that period? So November, again, one of the strongest months at up 2.1% for the SPY, 1.1% for December. To wrap up the segment on seasonality, though, I can't help but look to the beginning of next year. Look at how bad January tends to be, right? 45% of the time over the last 20 years. So that's not just a bull phase. That's bull phases, bear phases, all kind of jumbled together. So going back to the 2003 low. 45% of the time, less than half the time, January has been a positive month, and it's the worst performing month out of the 12. Average return negative. It's only one of 3 months that actually have an average negative return going back for the last 20 years. So the seasonal strength that you see in November, which very much played out, the seasonal strength that you would expect in December, which we may be seeing on a day like today, the beginning of it. And again, all it would take is the Fed to have sort of this is going to be an easy soft landing type of comment. I think you could easily have a positive December with no issue. The problem is we're setting up for a weak January. Now, from a macro perspective, thinking about the Fed through the course of this week, right, as we get a sense of where the Fed may be headed in the new year, January is maybe where we're out of the holiday season and we have sort of a realization that the landing is still going to have its issues and it's going to be some negative data that comes out, and all of a sudden January is pretty painful. A lot of times there's year-end window dressing. There's a lot of risk on bets that sort of get cleared up here, and then January is when things can sort of recover from that Santa Claus rally. It's sort of the hangover month when things sort of come back to normal and any issues that were cleared up and idealized become right back to the issues that we had. So again, strength in December often leads to weakness in January. That's what the seasonal tendencies would suggest. That's what I'd be concerned about going into the new year. Let's take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close. As a reminder, a couple quick announcements before we get to our next segment on shifting stocks. We have a mailbag that is always open. Our email address is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv, and we're on YouTube. Just put a comment below the video you're watching on our Stock Charts YouTube channel. We'll get all those questions. Hope to answer one of yours live on the air on Tuesday's show, tomorrow's show. Also, go to StockChartsTV.com. That's our on-demand platform. There's so much fantastic content. And I tell you, as we get into year end, we will do a special series of shows for the Final Bar with a retrospective look back at 2022. A number of my other hosts on Stock Charts TV are also doing a special year-end program, which we'll be running in the last couple of weeks of the year. So there's going to be a lot of great content to help you make sense of things. We're planning some really cool market outlook content in January. All of that sort of stuff is available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on our show today with our next segment, Shifting Stocks. Now, what I often do with this segment is to share with you individual names, because on the course of a normal day, I'm looking at a bunch of individual stocks, whether I have clients asking about them, whether they come up in our mailbag, or whether just through the natural course of following the markets and observing and analyzing. But today I wanted to highlight one particular thing. And if you look at the screen that I'm showing you, it is looking at year-to-date performance on a bucket of stocks. And the Nasdaq actually just announced changes in the Nasdaq 100. I actually forget what date this was, and I apologize. I meant to have that in front of me, but it's coming up pretty soon. It might be on the 19th. It might be a week from today. But you may want to check me on that particular date. But coming up soon, they will be reshuffling the members of the Nasdaq 100, which does not happen very often. There's actually an annual rebalance on the Nasdaq indexes. The Nasdaq 100 by far the most common one that is followed, because the Qs, which is a very liquid, very highly traded ETF, is based off of the Nasdaq 100 index. You can see on this list here, I've put in the names of the stocks that are rolling into the Nasdaq 100. Baker Hughes, CoStar, Diamondback, Global Foundries, Rivian, and Warner Brothers Discovery, and then 7 stocks that are rolling out. The reason why I wanted to show this is just to talk briefly about what this may do to those individual names, what it means when an index is rebalanced, how that might impact you if you hold some of these names or if you don't hold some of these names, and what it really all I think means to should mean to you as an investor. It's funny when we look at charts of the Nasdaq 100, and we'll look at the Qs here briefly, just as a way to set the stage for the conversation. When you look at something at the Qs, we tend to think of it as a stable bucket of stocks. These are the Qs, this is the Nasdaq 100. It has this group of 100 stocks, and we're just tracking those 100 stocks and how they evolve. And as a result, when the index goes higher, when the index goes lower, we think of it as that group of stocks that are going higher or lower. What you have to remember is every index on the planet gets its members rebalanced with some frequency. Some very rarely, right? So some like the Dow 30, very rarely there's a change in the Dow. It's a fairly stable group of stocks. Something like the S&P 500, there are actually changes often. About once a quarter, you'll get changes in the S&P. And not many, right? A couple stocks at a time, maybe one or two. But it has a potential to certainly change things, right? Here's the thing, though. As a result, this chart of the Qs, the further left you go, you're looking at less and less of the same bucket of names. So if you go back 10, 20, 30 plus years, all of a sudden the configuration of that index can look very different. This is one of the big, issues, I would say, with indexes and with benchmarks. My time at Fidelity, I spent a lot of time digging into these sorts of things with our data team, with our quantitative team, because we realized that reshuffling an index has a lot of ripple effects for those particular stocks, but also needs to change the way you think about what a benchmark represents. And here's the reality. The NASDAQ 100 should represent the top 100 stocks by size in the NASDAQ 100. And I think they intentionally exclude financials, if I remember right. It's hard to keep track of all the different providers and what they're doing with the indexes. But if I remember, that's what my brain is telling me is what they're doing, which means about once a year, you need to look and make sure that your index is focused on the 100 biggest stocks. So these are the 13 stocks we have to work on, 6 that are coming in, 7 that are coming out of the index. And if we sort the group by year-to-date performance, here's what you'll notice. 4 of them that they're bringing in are the only 4 that have positive returns. So there are 2 energy stocks that are going to go into the NASDAQ 100, up 32.5%. We have Diamondback Energy, up 20.4%, Baker Hughes. So I tend to think of the NASDAQ 100 as a very tech, consumer communication heavy, new economy types of names. The reality is there are energy stocks like Baker Hughes and Diamondback that are listed on the NASDAQ. And because that index is, and because that sector has done so well, there was will have some representation in the NASDAQ 100. Also, CoStar Group and Global Foundries would be the next 2. If I remember right, I think these are both in the, semiconductors for GFS. And then CoStar is in the industrial sector. Yeah, business support services. Now, the rest of these obviously having pretty negative returns. What's interesting to me is you have something like Rivian, which is down 75%. Warner Brothers Discovery down 53%. The challenge is a lot of the NASDAQ names have been down quite a bit. And so as a result, the names at the top of the list are shuffling quite a bit as we sort of go around and digest these changes in market cap that have been the result of the market moving so quickly. 2 of the names rolling out of the index, which I wanted to highlight, would be DocuSign and Match Group, right? These 2 are sort of, one of the many groups I think of as sort of the sort of COVID names, right? The names that did really well coming out of the March 2020 low. This is along things like Peloton and Zoom and others, where it's like this is the new reality, right? These are the names that were going to be able to survive all of this by following and by using. But if you look, DocuSign has obviously had a really painful 2022, big gap down in December, but actually peaked out back here in July of last year. From there has been in a pretty consistent downtrend. Match is another one. MTCH is this one right here. Just a beautifully consistent downtrend, peaked out in October. So here's the reason why I wanted to bring this up. Match and DocuSign are two to highlight inconsistent downtrends. The reality is their performance has been so bad that they're no longer part of the ETF. They're no longer part of the index. So the Qs will no longer include those. So what that means is two things. What happens if DocuSign has a dramatic return to grace, right? It bounced a little bit off of the lows so far, up about 15 points out of a bottom about 6 weeks ago in early November. Something like DocuSign really rallies. It has no chance of being in the Nasdaq 100. You don't have exposure to that stock for at the very least another 12 months unless you would buy it directly. So this is one of the realities. Stocks that do very well, like a Baker Hughes or any other energy name, have the chance to be included in benchmarks. So the benchmarks will often shuffle away from things that have done poorly, shuffle into things that have done well. So what does this mean for you and your portfolio? I would say, what does that mean for the chart of the Qs? Probably not a ton, right? And that's the reason why when you look back on the chart of the Qs, you can't necessarily see when those shuffles have happened because it tends to be relatively seamless and these names tend to even out. You will often see a bounce on some of these names that have added on, which is why it might be interesting if you own some of those stocks or if you look at some of those spaces, pay attention to this list of names and make sure you're aware that is going to have some fluctuation because a lot of companies, a lot of money managers that buy directly that basket of stocks now have a group of stocks they need to sell and a new group of stocks they need to buy into to build a meaningful position and track the index for whatever reason they may want to do. But also caveat emptor, but let the buyer beware. Remember, when you're buying something like the Qs, it is not a consistent bucket. It is a bucket that changes based on market conditions. And the Nasdaq 100 just got a little less tech, a little less consumer, a little more energy. We need to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're going to Tesla. Tesla breaking down yet again. It's not just today. It's down 6 1/3%. It's been going down for a while here. And I think that's one of the challenges when you look at the XLY and you wonder why it's not doing better when the market's done so well off of the October lows. And the reason is two of the biggest names, Tesla and Amazon, which are the two biggest names in the XLY, have been struggling quite a bit. Tesla, right at a new 52-week low, and Amazon not too far behind, very close to making a new 52-week low on its own, although it did have a positive day today. My question for you, if you're looking at the chart of Tesla, right? Clearly in a downtrend, clearly has been making lower lows and lower highs. I don't think there's any debate that the chart has been in a downtrend at the very least for the last couple of months, arguably for the last year. What would you need to see on this chart to turn constructive, right? We're making new lows. We're below 2 downward sloping moving averages. The momentum is below 50. The relative strength is going down. What would you need to see on this chart to get excited? Now is the time. Just like when a stock is doing well, you want to think about your exit strategy. When a stock is doing poorly, think about your entry strategy, right? What would you see on this chart that would convince you to buy Tesla if you're not already? And if that's the case, set alerts, write it down, set some sort of reminder to make sure that you follow when a chart that has been in a down phase starts to turn into a more attractive potential entry point for you. Chart number 2 is looking at sector performance. We had to skip our segment today on sectors, but I did want to highlight this particular one. If you look since the October low, which was on October 12th of this year, the market obviously has rallied pretty nicely. The S&P, trying to get back up and retest the 200-day moving average. If you look since the October low, in green, we have the energy sector. Even though energy has been the best sector year to date, it's only up 6% off of the lows, 5.9%. In red, we have the S&P 500, which is up 11.9%. Technology has outperformed. It's up 14.8%. In black, we have the utilities sector. So out of these 4, the best performers since the October low, utilities up almost 18%. Finally, just quickly, I'm always trying to think about different charts, different ratios, different ways of thinking about this market environment. This is a work in progress. I just wanted to share with you quickly where I'm at. This is taking my market trend model, but instead of applying it on the S&P 500, I'm applying it on the ratio of Bitcoin to gold. So basically, Bitcoin, digital assets to gold, hard assets. This has obviously been in a downtrend as Bitcoin has been struggling. My market trend model says still very bearish. Looking to see when this might turn higher. Does that tell you to be more optimistic about risk assets? Folks, That's a wrap for the show. Thank you so much for joining us. We'll be back with you again tomorrow with more great content. All of our previous interviews and episodes can be found at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.